Well, welcome back. Americans are still reacting to a volatile week for the banking industry after the collapse of Silicon Valley Bank and also Signature Bank. Fed stepping in to help out both of those banks.
Absolutely. Joining us now for more is chief economist and host of the SchiffRadio.com, Peter Schiff. Thank you so much for joining us, sir. First, Citizens Bank, is there a possible buyer for Silicon Valley Bank? What can we expect to happen next?
Well, I don't know if anybody wants to buy the bank. The problem is most of the banks now, I think, in the United States are technically insolvent. And this is the result of a dozen years of 0% interest rates and quantitative easing. The Federal Reserve created the first financial crisis with artificially low interest rates. And the current financial crisis is actually even worse because it kept interest rates even lower for longer.
So SVB, they filed for Chapter 11 2 days ago. What does this mean? Is this a formality? What happens next?
Well, I think what happens next, unfortunately, is more bailouts. We've already bailed out several banks and their large depositors. The president of the United States is pretending that this doesn't cost anybody any money. It's going to cost everybody because inflation is the way we're paying for this. The Federal Reserve's balance sheet is now blowing up. It's back to quantitative easing, which is the reason we got into this predicament in the first place. But everybody's bank account is now at greater risk than ever, maybe not because your bank is going to fail, because the government is not allowing that to happen, but because everybody's bank account is going to lose value, because inflation is going to destroy the value of everybody's savings.
There's also, too, that you're seeing a lot of these other banks that are bailing each other out. Is this the wave of the future? Is this what we can expect to see when another bank is on that verge of collapse? Are we going to see other ones come and try and save them?
Remember, a lot of these large banks that are putting money now in other banks, they're getting the money from the Federal Reserve. Remember, these large banks are able to take their treasuries and mortgage-backed securities, which have depreciated dramatically because they were foolish enough to invest when interest rates are at all-time record lows. So they're able to take paper that maybe is worth 70 cents and just give it to the Federal Reserve in exchange for $1. And then they're taking some of that windfall and depositing it in other banks. So the whole thing is a bailout in disguise. And again, the bag holder is the American public. They get the bill in the form of higher prices.
A new study from the Social Science Research Network found that nearly 190 U.S. banks could be vulnerable to a similar type of collapse as SVB. You know, the question on everybody's mind, is the banking system safe?
No, it's not. It's completely unsafe. But again, even if the government steps up and bails out all these insolvent banks and stops the runs, the only way they can do it is by printing trillions and trillions of dollars, and it gets spent into circulation. So either you're going to lose your money because your bank fails, or you're going to keep your money because your bank is bailed out, but your money isn't going to have much value. So what good is it if you can withdraw your money, but when you go to spend it, you can't buy very much?
Yeah, exactly right. And let's play a soundbite here from Treasury Secretary Janet Yellen on the interest rates, having said that.
My understanding is that the bank, to meet liquidity needs, had to sell assets that it expected to hold to maturity. And given the interest rate increases that have occurred since those assets, including treasuries and government-backed mortgage-backed securities, they had lost market value.
Yeah, a lot to unpack there. But the question people at home want to know is the Fed going to have to reconsider these aggressive rate hikes?
Well, first of all, Janet Yellen is incompetent. She was incompetent at the Federal Reserve Bank of San Francisco. She was incompetent as Fed chair. She kept interest rates at zero for practically her entire term. That's what helped these banks load up on these low-yielding treasuries. But unfortunately, the Fed is going to stop raising interest rates. It's already gone back to quantitative easing. They should be raising interest rates much more. And the government under Secretary Yellen should be cutting back spending. If she was competent as Secretary of the Treasury, she would be telling her boss, Joe Biden, that we need to dramatically cut government spending. Instead of trying to raise the debt ceiling so we can go deeper into debt, she should be advising her boss to start cutting spending and actually pay our bills so we don't have to raise the debt ceiling.
Right. Stop the bleeding, right?
Well, that would mean she would actually be doing her job or know how to do her job. Thank you so much, Peter Schiff, for all that you do. Thank you, sir.